how do we think about this after this historic move yesterday and the give back today, the so-called transition costs that the president says are going to happen as a result of what he's trying to do?
Well, it doesn't make the bulls from yesterday afternoon feel too good, and I don't think the bears should be feeling good as well. I think it's very clear the most important thing on your trading screen is where the 10-year Treasury is pricing, because we have learned that's where the Trump put is in the marketplace without...
In the bond market, not the stock market.
Oh,
that's
absolutely.
what you're alluding to.
Not in the equity market. It is in the bond market, and he's going to
probably in the equity market, too, just as Eamon was saying, a lot lower than where we are now.
So I think what's interesting is, and what's interesting about today is the 10 years at 440. Think about that. After the CPI, the 10 year should not be at 440. So it's another day of what should be happening to the 10 year is not happening, and you're kind of puzzled by it. But I think we're going to get a lot of appearances from the administration, and the intraday low today was at 1227. Right as the cabinet meeting was about to start. So you have to be careful here playing the short side, because I think you're going to hear, whether you get the comforting news, you're not going to get the type of comforting news you got yesterday, but you're going to hear the words, you're going to get the appearances, and that's going to attempt to try and pull the market away from the critical lows of the last several days. But overall, I don't think we're out of the woods here. I think the personality of the market is still very defensively oriented.
Is that how you see it?
Yeah, I think it's clearly way too early to say the all clear. And I think people were hoping for that yesterday. But really where we ended was it looked like we were going to have this all-out trade war. And now it's kind of a head-to-head with these two largest economies in the world, which is the U.S. and China. So clearly that has not subsided. We also have a 90-day delay, but this is also not yet a reprieve in tariffs. So markets are really trying to figure out where to go here. And that's what I think as an investor you need to continue to watch here. And there has been some underlying good data, which, Joe, you point out very accurately here. Like the CPI just came down. It's now at 2.4%, which bond markets may not be reacting the way we think. Neither are the stock markets, which typically would react positively to that news. So clearly markets are setting that aside because they see tariffs as a bigger concern here. And also last Friday, when markets were in turmoil, you saw unemployment is still at a good level, showing we have a strong labor market. So the economy is coming into this in a good direction. It's still in a good position. It's just, what are tariffs going to do to that? And that's what markets aren't sure of at this point.
These moves, I mean, as you know as well as anybody, because you like literally study this kind of stuff, are so abnormal to see that we're down 2,100 points on the Dow at the low plus, and we came within a whisker of the circuit breaker for the S&P 500, which marks a 7% decline. As I ask you the question, we're only down 3% on the S&P. It's such volatility that it's kept everybody off balance.
It's such a good reminder that big up days are very normal in bear markets, that they're not necessarily healthy. So the big up day that we had yesterday does not mean that we're at the start of a new bull market, because if you go back to those big historic up days, they typically happen in the midst of major bear markets. So we think at the end of the day, vol is here to stay. And if you go back to Strategas, Chris Verone, he put out an interesting stat. 85% of the time, you retest the lows. And so there are certain scenarios like 2018 or 2020 where you had a true V-shaped recovery. But given the fact that this is true policy uncertainty in the hands of one person, we think that you have to get used to this volatility remaining.
One of the issues, too, is that even with what happened yesterday and the fact that you have now these elevated tariffs on China and a full-blown trade war between these two countries, it keeps recession risk very high. It keeps uncertainty very high. The opacity that CEOs have had doesn't look to be clearing anytime soon. Our senior economics reporter, Steve Leisman, joins us now. You know, there's that, the uncertainty that persists. There's this view that Eamon was talking about, that the president sort of whimsically, talking about these times of yesteryear with, 90,000 factories that left and they're all going to come back and more. It just doesn't seem to be a credible view that something like that can actually take place in any real world scenario.
Yeah. Scott, I like to say you can't make a deal with the past because there is nobody around from the past with whom to make a deal. And if you could make a deal with the past, you would hold no cards. I think that's the way to think about it. And Scott, just one thing. I don't think we debate enough some of the things the president says. He says those other countries got rich at our expense. That's really not true. To the president, anytime there's a trade deficit, they're ripping us off. It could be that there are trade barriers there and their trade is unfair or they're subsidizing their trade. It could be because they are poorer than we are, most likely. It could be because they have stuff we can't build. And the most important part when we talk about the economic outlook, it could be because they have an input to our manufacturing process that ends up being an essential and an essentially lower priced component that we need to have manufacturing in this country. There's all kinds of stuff that we bring in. I think it's something like 30 or 40% of our manufacturing is done in part with imported products. So we are going to get poorer, Scott, and that's why a lot of economists right now, they still have very negative numbers when it comes to the GDP impact of these tariffs and also the inflationary impact of these tariffs. Yesterday, the market was ebullient and the dismal scientists were dismal. They looked at it and they said, well, wait a second. What just happened there? You cranked up the tariff on one of our biggest partners? That doesn't change anything. In fact, it changed very little. I'll give you the tail of the tape here, Scott. 3% were the tariff. There's Goldman Sachs saying they went from 65 to a still elevated 45. Drew Mattis at MetLife was very unimpressed. He went from a 75% recession risk to 60%. J.P. Morgan, I talked to Bruce Kasman. He kept his recession outlook. And then Morgan Stanley said it lowers the immediate downside risk, but we're going to be uncertain for a while. One more chart I'd like to share with you, Scott, which is what happened to tariffs. Here we go. We were at 3%. The Rose Garden announcement raised it to an average of 30. The current is 25, and it depends on what you do with China. But if you take out China, where trade may just stop, which is a very, very worrisome outcome, it's 18%. That's the highest since 1934. So economists heard it yesterday, and they thought, oh, this sounds great. Wait a second. Let me put the numbers in. It didn't sound so great.